If you have 500 rupees to invest, there's one product for you. If you have 10 lakh rupees, there's another. And if you have 1 crore or more, the game changes completely. But here's what nobody tells you. Most investors are using the wrong product at the wrong stage of their wealth journey. Today, we're going to fix that. We're breaking down mutual funds, the brand new SIF category, portfolio management services, and alternative investment funds, what they are, who they're for, and exactly when you should move from one to the next. Let's start at the foundation. Mutual funds. A mutual fund is a trust that pools money from thousands of investors like you and me, managed by a professional fund manager and invested into stocks, bonds, or a mix of both, depending on the fund's objective. Mutual funds have become the go-to investment vehicle for retail India for 4 simple reasons. They're regulated, accessible, affordable, and diversified. SEBI tightly regulates every mutual fund in the country, which means your money is protected by clear rules, mandatory disclosures, and strict compliance. And you can start an SIP for as little as rupees 100 a month. But here's the thing. Mutual funds operate under strict SEBI guidelines about what strategies a fund manager can and cannot use. They can't use complex derivatives beyond basic hedging. They can't take highly concentrated positions. This is a feature, not a bug for most investors. But as your wealth grows, you might find yourself wanting more. And that's exactly where our next category comes in. Let me introduce you to something very new. Specialized investment funds, or SIFs. Think of SIFs as mutual funds but with a performance gear that standard funds simply don't have. SEBI introduced the SIF category to fill a very specific gap. Sophisticated investors with 10 lakhs or more didn't have a regulated product that could use advanced strategy. Their only options were regular mutual funds or jumping all the way to PMS. SIFs bridge that gap. So what makes an SIF different? First, advanced strategy access. SIF fund managers can use long-short strategies, take concentrated positions in high conviction ideas, and use derivatives more actively to generate alpha or manage risk in ways a standard mutual fund simply cannot. Second, the minimum investment is rupees 10 lakhs. This is SEBI's way of saying this product is for investors who understand risk and have meaningful skin in the game. Third, and this is important, SIFs fall under the mutual fund framework. Just like regular mutual funds, they are managed by a trust, which means the same investor protections, the same disclosure standards, and the same trustee oversight apply. Your money sits within a well-governed structure you can trust. And here's another advantage that often gets overlooked. Just like mutual funds, when the fund manager rebalances the portfolio or switches between positions inside the fund, you are not taxed for those changes. Tax is only triggered when you as an investor actually redeem your units. This is a meaningful benefit compared to owning stocks directly. Fourth, elevated fund manager qualifications. SEBI requires specific expertise to run an SIF. So you're getting professionals who have demonstrated the skills to handle complex strategies. SIFs are brand new, and we're going to see a lot of innovation here over the next few years. But the concept is clear and powerful. The sophistication of alternative strategies with the safety net of the mutual fund framework. Now let's talk about portfolio management services, PMS. PMS is a personalized investment service where a professional portfolio manager builds and manages a stock portfolio for you. Your securities sit in your own demat account, actual shares of actual companies in your name. The SEBI mandated minimum investment is rupees 50 lakhs. PMS portfolios are typically concentrated, around 15 to 25 stocks, and are custom built around your individual situation. Since you own the shares directly, there's full transparency into every holding. That being said, PMS does come with higher fees, more complexity in reporting, and because portfolios are concentrated, drawdowns can be sharper than a diversified fund in difficult markets. It's a product that works well for the right investor at the right stage, but it's not for everyone, and it's certainly not a necessary step for every wealth journey. At the top of the pyramid, alternative investment funds or AIFs. AIFs invest in assets and strategies that go well beyond what conventional products can touch. Private equity, venture capital, real estate funds, pre-IPO investments and hedge fund strategies. The minimum investment is rupees 1 crore, though this can come down for accredited investors. AIFs come in 3 SEBI categories. Category 1 covers venture capital and angel funds backing early stage startups. Category 2 covers private equity, debt and real estate funds. Category 3 covers hedge funds, sophisticated long-short strategies and absolute return approaches designed to perform across market conditions. Lock-in periods can be long, often 3 to 7 years for private equity and real estate, though category 3 AIFs can be more flexible. The return potential is higher, but so is the complexity and illiquidity. AIFs are for investors who already built a strong foundation, have significant wealth, and are looking for truly differentiated opportunities that simply don't exist in public markets. Now let's bring it all together. This isn't about which product is better. Every single one of these vehicles has its place. The question is, where are you right now? What's the smart next step? Stage 1. Build with mutual funds. Start here. Build your SIP habit. Get diversified across large cap, flexi cap or a multi-asset fund. Add some debt for stability. Stay consistent, let compounding do its work. Don't overcomplicate the stage and keep building until your mutual fund portfolio crosses 1 crore rupees. Stage 2. Level up with SIFs. Once your mutual fund portfolio has crossed 1 crore and you're ready to deploy 10 lakhs or more into a single product, it's time to explore SIFs. The regulatory safety you're used to is still there, but now you get access to advanced strategies that can generate better risk-adjusted returns. Think of it as your portfolio's high-performance wing. Stage 3. PMS and AIFs after meaningful wealth creation. After you've built significant wealth through mutual funds and SIFs and your investable assets are well into the crores, it may be time to explore PMS and AIFs. At this stage, personalization, tax efficiency, and access to differentiated opportunities start to matter in ways they didn't before. But only enter this space with the guidance of a trusted wealth manager who understands your complete financial picture. So that's the complete picture. From a 100 rupee SIP all the way to a 1 crore AIF. The most important thing to remember, the right product isn't the most exotic one. It's the one that matches where you are today and where you want to go tomorrow. And that's where we come in. Book a one-on-one consultation with us today to build a custom roadmap for your family and figure out which products and investment avenues are right for you. Until next time, keep investing smart, keep building wealth, and subscribe to Money Lancer Wealth for more such videos and follow us on our Instagram page. Thank you.